Screening for potential equity investments. The idea here is straightforward. If you are an equity analyst and you want to identify certain stocks to buy, you can look at their financial data to identify which stocks to focus on. Here is an example of screening criteria. You might be interested in companies that have a price to earnings ratio of less than 15. The price is the stock price. The earnings refers to EPS, which we have calculated in an earlier reading. A low EPS means that you are paying a relatively low amount per dollar of earnings. So you might put in this criteria, and from your universe of stocks, you might identify 100 which meet this criteria. Then you might be interested in companies that have relatively low leverage. So you could look at the assets over equity ratio. Less than 2 means that you want relatively low leverage. Here you might identify 50 companies that meet this criteria. You might want companies that pay dividends, and here you might identify 75 companies. And then if you want companies that meet all 3 criteria, then the search might reveal that there are 25 companies that meet these 3 criteria, and then you can spend more time researching these companies. What I have shown here are simply examples. There can be several other criteria that you could use. This material will be covered in more detail when we do equity. If you are an analyst and you want to keep your risk low, then what sort of criteria are you likely to use? Again, there are several criteria that could be used, but you might, for example, say that the earnings have to be positive over the last 5 quarters. You might say that the leverage ratios such as assets over equity need to be relatively low, and there are other numbers or other criteria that you can use also, but this just gives you an idea. If the analyst wants low PE firms, then obviously he should have this criteria, maybe less than 10, which are financially strong. When we say financially strong, what we generally mean is low level of debt relative to equity. So we might say that the debt to equity ratio needs to be quite low. We might give a criteria such as debt to equity must be lower than 0.2. We need to recognize that there are different kinds of equity investors. We will mention this briefly over here and then see this in detail when we do equity later. Growth investors. These are investors who are focused on investing in high earnings growth companies. So typically companies that might have a growth rate of 20% or more. When companies have high growth rates, typically their price to earnings ratios tend to be high. Value investors are focused on paying a relatively low share price in relation to earnings per share or book value per share. Here, the PEs will tend to be low. In the US context, the PE might say be less than 10. Book value per share refers to assets minus liabilities. That's book value divided by number of shares outstanding would be book value per share. If you are buying companies that have low book value per share, that means they are relatively inexpensive. Market investors are an intermediate category. You need to understand this term called backtesting. This is where you evaluate how a portfolio based on a particular screen would have performed historically. Let's say that we go with the screen that was discussed on the previous slide and you've identified 25 companies. Backtesting means that you go back, say, 5 years and you run that same screen. You identify companies that meet the criteria, and then you see how would those companies have performed over the 5-year period. Since you are going back in time, you can actually look at whether your screen would give you stocks which produce a good return over the next 5 years. When you do backtesting, there are some biases that you need to be aware of. These biases are mentioned briefly here and they will be discussed in detail later when we do equity. An important bias that keeps showing up in the level 1 curriculum is the survivorship bias. This exists if delisted companies or companies that have gone out of business are not considered. If we only consider companies that have survived till the end, then our returns will tend to be overstated because we are skipping or missing out the companies that might have gone out of business. Look ahead bias exists if the database of companies that we are considering includes financial data updated for restatements. This means that there would be a mismatch between what the investor would have actually known at the time of the investment decision and the information which is being used as part of the backtesting experiment. And finally, data snooping bias might exist if excessive analysis is applied to the same data set. I'll not get into more detail here because we will see this later. Analyst adjustments to reported financials. When comparing ratios, adjustments might be required, and we have seen examples throughout the FRA material. Different companies might use different accounting standards. With inventory, for example, one company might use LIFO, another company might use FIFO. If you are comparing ratios that involve inventory, you have to make an adjustment. For example, both companies need to be presented as FIFO before you can make a comparison. However, before making adjustments, there might be some items that you should consider. One is the importance. Here we consider whether the adjustments that we are considering will really impact our decisions. If we are evaluating a company where inventory is a very low percentage of current assets, then it might not make much sense to do the LIFO to FIFO conversion. We should also look at whether the companies we are comparing are using the same body of standards or different body of standards. If different standards are being used, then it would generally be important to make conversions. Methods. When we compare companies, we should look at whether they are using the same accounting methods or different accounting methods. For example, you might have one company that is using straight line depreciation, another company might be using accelerated depreciation. Here, adjustments need to be made. And finally, estimates. Continuing with the depreciation example, two companies might be using very similar assets, but one company might be depreciating over 10 years and the other company might be depreciating over 8 years. So we need to recognize that the two companies are using different estimates, because of which there will be differences in expenses and income. Coming now to some specific adjustments. A lot of what you will see here is a recap of material that has been seen earlier. Adjustments related to investments. Let's say that company A classifies financial assets as available for sale and company B classifies similar financial assets as trading or held for trading. If you remember the reading on balance sheets, you will recall that any unrealized gain is shown as other comprehensive income if the financial asset is classified as AFS. The unrealized gain is shown as income in the income statement if the asset is classified as trading. This means that the net income numbers will be different for the two companies. And if we are comparing the two companies, then an adjustment is necessary. Inventory. I have already mentioned this. If you are comparing two companies where inventory is significant, one company uses FIFO, the other company uses LIFO, then we need to make an adjustment. When companies report inventory using LIFO, and this is only allowed in US GAAP, or we should say it's allowed in US GAAP, it's not allowed in IFRS. When companies report using LIFO, they are required to also provide a LIFO reserve. This is a number that when added to LIFO inventory gives us FIFO inventory. If a company reports LIFO inventory on 31st December 2010 equal to 100. That's LIFO inventory. In the footnotes, the company will also disclose a LIFO reserve. Let's say the LIFO reserve is 10. What that means is, if the company had reported using FIFO, then the inventory would have been 110. What the footnote might sometimes say is that if inventory had been reported using FIFO instead of LIFO, then the number would be 10 more. The point being that the term LIFO reserve is sometimes used explicitly, sometimes it's only in the English that the footnotes explain what's going on. Example 10 shows us how this adjustment is made, and effectively it is this simple calculation. Example 11 talks about adjustments to inventory values before comparing current ratios. Clearly, if you have two companies and you are comparing the current ratios, it makes sense to first bring the inventory to the same system before comparing. Goodwill. If you recall, goodwill is put on the balance sheet when a company acquires another company and pays more than the net fair value of assets. So consider two companies A and B. Both are identical except that A has grown through acquisition and B has grown organically. Organically means that it has grown on its own, it's not acquired other companies. What is the impact on goodwill and total assets? Obviously, the company that has grown through acquisition will have a higher goodwill number, which means that it will have a higher asset number. So the equity will seem higher. But does this mean that company A is better? The answer is not necessarily. When we compare company A and B, it makes sense to look at what's called the tangible book value. This is the book value of assets minus liabilities, where we have removed the impact of goodwill. So we remove goodwill and then what we are left with is tangible book value. At times we might also want to remove intangible identifiable assets such as copyrights, patents, and so on. So strictly speaking, tangible book value means that we are only considering the value of tangible assets. Estimates related to property, plant, and equipment. The information on this slide is fairly self-evident. We can study the balance sheet and income statement and make estimates about the equipment that a company has. For example, if we look at the number of years of depreciation expense which have been recognized, let's say we want to estimate this number, we can simply look at the total accumulated depreciation so far divided by the depreciation expense. If we want to see how many years of useful life remain for the company's overall asset base, then we can look at the net property, plant, and equipment divided by the depreciation expense. The rest of this table is fairly self-evident. That brings us to the end of the reading, a summary of the important points. You need to evaluate a company's past performance and explain how the strategy is reflected in the financials. The Apple case study that I spoke about briefly is a good example. You need to know how to project net income and cash flows. The big item there is you first project sales. For a stable company, you can project expenses based on ratios. Even for a stable company, you should generally project the interest expense separately based on debt and interest levels, and you should also project the tax expense separately based on revenue and expenses. To assess credit quality, the big thing to consider is cash flows. If cash flows are stable, then the credit quality generally will be good. We talked about data in financial statements to screen equity investments. If you want relatively safe companies, then you will put criteria that says that earnings need to be positive, dividends need to be positive. Maybe you can also say that the leverage ratios need to be less than a certain number, and so on. And finally, we talked about making adjustments. We need to recognize where and when adjustments help. Once we have recognized what adjustments need to be made, then we need to know the proper steps for making adjustments. Before comparing ratios, we need to make sure that we are comparing apples to apples. That's what adjustments is all about. As always, read the summary, review the learning objectives. I have mentioned several examples. Most of the examples are long-winded. The MCQ example that I referenced, you must do that. If you have time, then you can read the other examples. I think they are useful general knowledge, but not overly testable. Practice problems are great, extremely testable. Do them very carefully, and also try to do practice problems from other sources. That is it.